And so I'm over here watching this, and really just not seeing that much at all on it. So whereas oil, I have a great potential short over here. We got 10 minutes, so 5:10. I got a reversal volume bar there going on. So quite a bit happening. And let's see, we can just throw on. Let me throw on my expected volume on this chart. Got some stuff on my other charts, but just to make it where we can all see it together. All right. So we'll grab that. Give it just a second to load. See what kind of setup we have here. Here, let's actually just move this up here. We'll shrink that down. So look at this declining volume on this up move. So, if I'm reading volume on that, I got to go back and go, hey, do I have any kind of resistance level way up here? So back here, we broke through this level. This is a sort of an older magnet support resistance level at this point. We're coming back down off of it. Okay, so we got that right there. Let's check it out, dig a little bit deeper now. Okay, so that's our trade. We got a short trade. We have declining volume after a run up this morning. We got a spike striker on it. We put all the pieces together. I go, okay, well, I want to check out what's available in oil, see if I like any of the contracts that I see. So we go to binary scanner. We go to oil. Choose live over here. And that would be the main contract, 96.21. 96.12. That's actually not bad. You get that for $31. So we can go in. We can short that contract. Put that one on. So again, that's selling the 96.21. Place the order there. It gets filled. Okay. And market's moving on us a little bit. Already starting to take off. We need to adjust our order quickly and amend to get in. Okay. So we're in the contract. Now we got to set up a take profit plan. So what is our take profit plan? Okay, well, the first thing I do whenever I set a take profit plan is I'm going to go in and I'm going to actually expand out the binary contract size. And let's see what else we can do. All right, so I want to go down here and I want to get rid of all my filters. All right, welcome on back. So let's check out where things are at right now. And so we got this oil trade on. We're looking at it as a potential trade. Or not potential trade, we actually have the trade in. And we went in, we looked at going short the 96.21, basically a slightly in the money binary contract. And the biggest key I want you to focus on at the moment is actually on the where to take profit. And learning this step. And that really involves one important thing, and that is looking at and paying attention to, because you got to have your stop on already, but looking at, as far as where do I know where to take profit at on the contract, if it moves down, if it moves in my favor. Well, you're going to see that by looking at a binary price ladder, okay? So right over here, we're going to look at this and we're going to go, okay, well, what is the binary price ladder? Well, a binary price ladder is basically all the prices listed for a binary contract. And you're going to look at the bid and the offer spread. And one thing I want you to notice is when you run out of bids, because your bid offer spread basically makes it where there is no bid because it's down at zero, then that is where your volume disappears. Okay, so see like with there's $6 right there, you got like 21 contracts. It's actually pretty high for that level. We go over here. Yeah, they haven't actually sucked it all out yet. Usually they do. Let's go to something like this. Maybe they're just putting it all in there today. All right, 200 contracts. So there's maybe a little better example for you, but like 200 contracts right there, and then we go down one more level, and there's like 10 contracts. Okay? So that's more what I'm talking about. You want to be able to look at that, and you want to be able to see that the size, so let me put them up side by side for you. Okay, right here and right there. 200 contracts versus, 10, 20, 30 contracts, whatever it is that they're listing at the moment. And that actually looks like a secondary market maker. That's not the primary market maker. But when there's no bid offer, a lot of times you won't see any kind of volume on either side. Obviously, you'll see nothing on the bid side, because if the bid offer is about $5 or $6, $4, well, they're not going to go in and let you buy it from them at zero. That'd be awesome if I could buy at zero. I'd buy those all day. They're not going to let you do it. So I went in and I put my take profit there at like $10. Anyways, but let's see why I did that. What was my logic? Well, we have about $4 wide here at the end, but they're usually a little bit wider on the intradays. So let's look at the intradays. Intradays, we're seeing about $6 wide. Okay. Notice there's a 575 here with no bid. This one does have one. It looks like the market makers are competing a little bit. So, but that's actually 2 out of the 3 market makers are listing on that right now. And let's go here. Let's see what we got. Same thing. We actually have there's some markets going on. So the market makers are competing a little bit, so that's making the bid offer actually got really tight there for a second. It was like $1 or $2. Gotta love that. But there's 2 market makers when you have a consistent size, like all the way down the chain. Okay? But knowing that the bid offer is somewhere between $4 and $6, I'm going to go on the heavier side. I'm going to go on the $6 side just because I don't want to risk trying to push it. Okay? And I want to make sure I get out. Now, a lot of times I'm doing a lot more than 10 contracts, or more than 1 contract. So it's really important to me, because if it drops down to 5 or something, then I can't even get out of the trade on my entire position without having to wait for them to refill it. I can get out, but it's like they'll have to refill. I'll take out, say there's 5 listed, they'll take the 5. It'll come back, I'll take it again. They'll come back, I'll take it again. And it can be a very painful process. Sometimes it doesn't always work out so well, and it can really go against you. Okay? So if it's $6 wide, and we're just going to go ahead and assume 6, even though it could be less. I mean, right now I see 3, I see 4, I see 6. So I'm just going to go with 6. Then 6 by 0 would be no bid. Okay? Therefore, I want to raise it a little bit above that. Let's go a couple bucks above it, so that it would be like a 2 by 6. Okay, or 2 by 8 actually, because $6. So if you're not quite following what I'm saying the difference between the bid and the offer. Okay? And on some of these contracts, depending upon just which one I'm looking at, it may be $3, maybe $4, maybe as wide as $6. So I usually go with the wider of the group there. And so if the difference between the bid and the offer is $6, then I want there to be a bid and an offer on both sides. There won't be a bid at 0 and an offer at 6. So there'll be no bid and there'll be an offer at 6. That means the liquidity drops down from like 40 to 20 or 40 to 5 or 40 to 1, okay? On the buyback side. So because I want to buy it back, I sold it higher, I want to buy it back lower. So I'll add a couple bucks to that, and that's helped me come up with my price. So we'll walk through this a little bit more, make sure you get this. It's one of the most important aspects when you're trying to maximize those profits. We'll be back right after this. All right, folks, we're going back here to the Bull Bear Binary Option Hour. And we're looking at this oil trade now. We sold at 27. We got a buyback to take profit at $10 on the trade. Really, you could have put it in as tight as 8. Basically, look at that. What I was saying is take that bid and ask spread, okay? So we basically looked at it and we were like, okay, the bid ask spread is about $8. So $8 right there, or $6 is the bid ask spread. We add $2 to it. So that's to be safe, because basically we want to get out of the trade before we maximize that bid ask spread getting to 0. Because remember, if we lose the bid, then what's going to happen on the trade? If we lose the bid on the trade, the volume, the liquidity is going to go way down. So I want to get out before the bid offer spread goes away, before I no longer see both quotes. If I get out before then the liquidity is still there. Therefore, I look at what the bid offer spread is, I add a couple bucks to it, and that's my exit price. So, like I said, you could have chose 8, I chose 10, whatever, give or take a couple dollars there. The big thing is just be out before the bid-offer spread goes away, especially if you're trading size. If you're trading 1 or 2, you're probably not even going to notice this. And it's one of the important reasons to bring it up is as a small trader, when you start to get bigger, you don't know about these things. As you start to add on to your size, because you're just doing singles, and it's like, well, 5 is enough for you, right? If there's 5 contracts quoting, you can get out of your trade. No big deal. But when there's, when you're doing 10, 20, 30, 40, 50 contracts, then you're really going to start noticing on that trade. So pretty simple. There's not a lot to it. It's not a hard concept, but it's one that if you don't know, it can really come back and bite you. And you'll wonder what happened. Why can't I get out? Are they trying, is the market maker trying to screw me? And da-da-da-da-da-da, all these things that come up. It's like, well, no, they can't lay off the trade, okay? Understand a market maker is trying to make a bid-offer spread. That is their goal as a trader, to make the bid-offer spread. And if they make the bid-offer spread, that means that they bought from you at, say, 14, and they sold to somebody else at 21 or whatever. Okay, so they will basically, they bought from you like right here. This bid-offer spread 17 by 19 right now. So, or 15 by 17. It's moving on down, which is good for our position. But basically, if you went and said, "Hey, I'll sell at 16.75," they're buying from you at 16.75. You said, "I'll buy at 17.50." They're selling to you at 17.50. So they're making the difference between those two prices right there. Well, if they just take one side, if they just go in and say, "Okay, well, you want to, buy it, 5, I'll sell it to you at 5." Well, they can make $5 if it goes down, but they're not. But they could lose 95 if it goes up. Okay, they have no way to weigh off the bid offer. They can't weigh it off on the other side. They can't go, "Okay, well, I'll sell it to you at 5 and sell it to some and buy it back from somebody else at 0," because nobody's gonna, that's not how it works. Okay, nobody wants to sell at 0, right? Because if they're gonna buy it from somebody on the sell side, nobody wants to sell at 0 because they can't make anything on the trade. And so, since they can't make anything on the trade, they can't weigh off the risk. If they can't weigh off the risk, they're gonna drop the size down dramatically from like 10, 20, 50, 100 contracts to maybe 1 or 2 or 3 or 4 or 5 contracts on the trade there. Okay? So, that's why the bid-offer spread goes away. They have no ability to weigh off risk. And when you understand the dynamics of how a market maker works, there we go. Just took our profits, so that's not too shabby. Just locked in, $175 there in the last 15 minutes. Anyway, so hope some of y'all were able to take advantage of that. And anyways, but if you understand why a market maker exists, that they exist to make a market, their motivation to make a market is to make the bid-offer spread. And if there is no possibility for there to be a bid-offer spread, then how can they make money? All right? It's nice that they're even making a market at all on the other side of the trade. Okay? And then knowing that, hey, if I was that market maker, what would I be doing? Well, I'd want to make sure that I was able to get rid of my risk, to hedge off my risk. I'm trying to make bid-offer spread, not trade directionally as a market maker. That's what you'd be thinking if you're a market maker. If you can't get rid of it, then you're either going to not make a quote, but they're contractually obligated to make a quote, even if it's only 1 contract or 5 contracts, or you're going to make a very small quote. So since they have to make a quote, they're going to make one, but they're going to drop the size down. And when you get that, you're like, oh, that's why the size goes down when there's no bid or no offer, because they can't weigh off their risk. And they can't make money on bid-offer spread when there is no bid or there is no offer. So they know that nobody is going to sell at 0, and you actually aren't even allowed to. Like if I go in here and I try to put in an order to sell at 0, like it won't let me. It'll give me an error. See, we cannot accept an order level of 0. Okay? You can't sell at 0, buy at 100. So not only could somebody not do that, but they're not even allowed to do that. Nobody would want to do that, and they're not allowed to do it. So it's not there. By the way, that's why we take profits. Look how that thing's popping on back up. But yeah, so we took our profit right there. We went in, we went short. We had declining volume. We bring the chart back up over here. And volume spiked up a little bit right here. Look at that, right in that little last down move, and then it turned right back around on us. So talk about timing the trade right there. Worked out very well. Yeah, it's moving on up. We'd actually be stopped out of the trade right now. So that was a perfect play. Taking that profit when we did. It's good to know where that's at.